Welcome back to another lesson on the trial balance. I wanted to go over a few other items here. First is the debits in this column, and the credits in this column should equal each other. If they don't, that's a problem. I will say I've heard about these two not equaling, but I have never seen it, thank God. Uh, they match. So something you shouldn't have to worry about, but it is good to look at it. There may be something going haywire in the background that we'll need to address, but that's typically something that'll just work itself out and you'll see those two match. The other thing is looking over your balance sheet accounts and making sure you can substantiate these balances. And by that, I mean you know that these are real balances and they're accurate balances. MasterCard, do you have a MasterCard? Do you owe money on that card? If you don't, then that balance should come off. If you do, should it be 157 or should it be $5,000? Keep that in mind as you're maintaining clean books during the year, because this all feeds into your working capital calculation. And the last thing you want is fake payables reducing your bonding capacity. So something to look out for. Something similar can be said with the asset accounts, inventory in this case. Do you have inventory? If you don't, that should probably come off the books. That's inflating your working capital in your favor, but we're not in the business of misguiding the users. We want to provide accurate financial statements here so good judgments can be made and you end up where you need to be. So that's something else in mind. Now, when it comes to cash, that's unique. You have your bank reconciliation. This is the book balance. When you're running your when you're running your bank reconciliation in QuickBooks or whatever system you're running, you want to make sure this balance ties to the book balance on your bank rec. This isn't what the bank is going to show. Obviously, this is just what it is according to the books, factoring in all the outstanding receipts and receipts and payments. So this should agree to your bank rec. Your accounts receivable balance. You should have an AR subledger, which we briefly went over in one of the earlier lessons, the AR aging. Your AR aging total, when you add up the 30 days, current, 60 days, 90 days, 120 days, so on and so forth, it should equal this balance. I will say that it often does not agree to this balance. That's because of journal entries, recording entries directly to the control account. This is called the control account, and not running it through the subledger. So don't worry if it doesn't agree. Ideally, it's not off by much, but you'll want to have a subledger that comes close to this balance here. We're looking at these accounts here. Truck, I'm assuming this is fixed assets. You'll have a fixed asset listing that should tie to the cost listed here. $13,000 isn't much, so that's probably one truck. But imagine it was two or three. You'll want the detail behind that. That's important. Your CPA that's doing the compilation, review, or audit is likely to have that detail, which is fine, but you just want to make sure that's accurate. Keep track of that information and don't just keep it as truck, but put some more detail in it. What type of truck, the year, the last four of the VIN. You want to keep an accurate inventory of those. AP, same as AR in terms of having a subledger behind that to substantiate that balance. MasterCard, you should have a credit card statement there to help you with that. I'm just kind of pick and choosing here, so how you approach it will be a little different. But notes payable, obviously, that may be drawing a line of credit, or this loan could be a draw on a line of credit. You want to keep an amortization schedule, keep some schedule so you know where you're at any point in time. And the same with car loans or equipment loans. That's something your CPA probably keeps for you as well, but it's recommended that you're aware of that information as well. So as we're looking at this, opening balance equity, debit balance and equity is not good. Not sure how they got to this point, but that's another topic of discussion. But look at your income statement accounts, make sure everything is in order, nothing looks too off, and by that I mean just ballooned balances that don't seem to make sense given operations for the year. So I recommend performing that high level review throughout the year, whether it's once a month, once a quarter, for sure once a year at year end. So that's the end of this lesson, and I'll look forward to seeing you in the next one. Thank you.